want to see a show of hands. I know that I'm speaking at a mining conference, but are there any economists or anybody who would dare admit that they're an economist in the crowd? No, there's a few. Any accountants? You know, I always say that economists are accountants with personality, but don't take that personally. But there's got to be engineers in here, right? There are engineers. There's got to be, right? Okay, so look, I'm only saying that because you know the story about there's the economist and the engineer and the accountant, and they're going for a job interview at a bank. And the engineer walks in, and the interviewer brings him into the room and says, "I only have one question for you, one question only, which is this: what's 2 plus 2?" And the engineer takes out a slide rule and he says, 4. Oh, very good. Wait outside. Brings in the accountant, says to the accountant, "I'm going to ask you the same question. What's 2 plus 2? And the accountant takes out his Hewlett-Packard calculator, says it's 4. He says, "That's great. Please wait outside." Calls the economist in, says to the economist, "I'm going to ask you the same question I'm asking your counterparts out here for this job. What is 2 plus 2? The economist gets up from the couch, shuts the door, shuts the drapes, shuts the curtains, and he says, "What do you want it to be?" Anyway, that is not today's sermon. Today's sermon, and I know everybody, as I was coming up, getting accosted about today's really great CPI number, and I was going to say that, you know, it was a great number because everything pretty well outside of rent was actually deflated. So much stuff in there deflated, it wasn't funny. It might be an inflection point for the Fed, we'll see. But it's telling you something about what's happening on the demand side of the economy. So I know the stock market rallied big time today on the CPI report. The label of deflation was in that report, especially on the goods side. Just keep that in the back of your mind. Furniture, appliances, clothing, building materials were all very weak. Keep that in the back of your mind. What I want to talk about, though, and talk about inflation, and I think we're going back into deflation next year. I know it sounds crazy. I was saying this back in 2008 when I was at Merrill, and in 2009 we were in deflation. People had inflation on the brain back then. Oil was $150 a barrel. We had the Chinese commodity super cycle. Everybody thought we went through Bear Stearns in March of 2007, 2008, and it was all over. But we know that it wasn't over. So I just want to say that we got to talk about the Fed, talk about inflation, deflation. We have to talk about how we're going to invest around the recession, okay? And the business cycle is the business cycle. Interest rates matter. And I think it's a useless debate to debate whether back-to-back quarters of negative GDP in the U.S. constituted an NBER-defined recession. I think that's a useless debate. The question is not the rearview mirror. The question is what is staring us in the face next year. And everything that's happened, from the lagged impact of the U.S. dollar, which has screwed everybody in the world, including domestic manufacturers in the U.S., but also the lagged impact of all these rate hikes. And now we're seeing it come home in Canada. We're seeing it come home certainly in the United States. That's going to be next year's story, is all the lags that's already happened. I'll get into some of that. But I also want to talk about what is the Fed really up to? Because the Fed knows that headline inflation is a lagging indicator. It knows that the pressures underneath inflation are starting to subside. They're doing something else. There's something else going on at the Fed. And that's why I called this presentation, "I'm taking the punch bowl away." And anybody ever hear of the person who actually coined that term, William McChesney Martin? Anybody has heard William McChesney Martin, who was like head of the Fed for, well, the suspense is over. He was head of the Fed for about 20 years, and back in October 1955, actually at an investment banking conference, he had the temerity to say, "This is what the Fed is doing." And he was saying, by the way, it's not about inflation. It's not about unemployment. It's not about the wages. And he was actually saying, here's what we're looking at. We're taking the punch bowl away. He said, and this is actually a famous term in the realm of economics, monetary economics, finance, this particular term about the fact that the Fed is the chaperone who removes the punch bowl just as the party is warming up. The big difference this time around is we have Powell removing the punch bowl after he was serving free drinks for a year and a half till 3 o'clock in the morning. So I would say that at least with Chesney Martin, and look, the stock market, by the way, stock market, commodities, they went nowhere for 3 years after this. He told you on the platter that we think there's a disconnect between Wall Street and Main Street. We're going to ameliorate that. And now we have the disconnect between Wall Street and Main Street today, okay, that we've never really seen before. It's even bigger than what we had during the dot-com craze. And I think that's what Powell is really up to. Powell is the modern-day Volcker. I'll talk about that. But he's also telling you that they don't want asset prices to go up. They want asset prices to go down. That's part and parcel of getting towards that long-term sustainable 2% inflation goal. They want asset prices to go down. So people say to me, look at this rally today in the S&P and the Dow's up 1,000 points. I said, yeah, wonderful opportunity to cleanse your balance sheet and your portfolio and de-risk even more. That's the opportunity as far as today is concerned. But that's what's happening. And the one thing we have to keep in the back of our mind is that when the Fed tightens, and when the Fed tightens, everybody else starts to tighten, right? We saw that with the Bank of Canada, Reserve Bank of Australia. Everybody really outside of China and Japan have been raising rates, and who got the ball rolling was the Fed, because the Fed is the world's central banker. Now, when they first started raising rates in March, I said, okay, we're in a new game. They're not cutting rates anymore, they're raising rates, okay? And when interest rates go up, funky things tend to happen, and they often happen with a lag, but I like to drive by looking through the front window. So I said, look, we are on a slippery slope now. Fun and games are over. Fun and games are over. The Fed is raising interest rates. And I have the evidence since 1950 that there's been 14 periods where the Fed embarked on this interest rate increase cycle, and 11 times, let's just say 80% of the time, we have a recession. And the lags are long and variable, but that's what waits in front of us. Just keep that in the back of your mind. So people will say, well, we have soft landings in the past. And I agree with that. I don't believe in 0. I don't believe in 100. I don't believe there's, after almost 40 years in this business, I know that there's no such thing as a sure thing. And I know that as an investor, you don't always put all your eggs in one basket. But I like to play the odds. I always like to play the probabilities. And I think that's what we all have to do. Pretty well with everything in life. It's all about probabilities and then outcomes. In the mid-1960s, the Fed's raising rates, no recession. Why? Because LBJ's, guns and butter, fiscal policy, and the fiscal deficit doubled in a 3-year span. There was tremendous stimulus. And that's why we didn't have the recession. We had a huge positive fiscal shock that more than offset the Fed's tightening. Now, you tell me, especially depending on the outcome. Looks like the Republicans, there was no sweep, but they're going to take the House, it looks like. There's fiscal gridlock. There's no stimulus this time. There's no stimulus coming to offset what the Fed has done. There's no stimulus from the fiscal side coming next year when it's going to be very clear. It will not be a debate anymore as to whether or not we're in a recession. I understand there's still a debate today. I think that debate gets settled next year. So there's no soft landing coming from fiscal policy. Well, people say, well, in the mid-1980s, we had a soft landing. Fed was tightening, soft landing. I say, well, look, I'm not going to say at this particular point in time, and this was back in March when I was running with this chart, and I'm just explaining it, in the mid-1980s, yeah, we had the Fed raising rates, but because the Saudis were stepping on the pumps to such a degree that oil prices went down 70%. And oil got down to like $10 a barrel, and that was a huge de facto tax cut for the U.S. consumer. No recession, admittedly. Then in the mid-1990s, if you remember, we had the dramatic 300 basis point tightening by the Fed, Alan Greenspan. Then all of a sudden, we're calling Greenspan Maestro in 1995, and we had the soft landing. Soft landing is basically slower growth, not a recession, and the Fed stops hiking interest rates. Soft landing is basically we're taking the Lamborghini down from 200 miles an hour down to like 80. That's a soft landing. And in a recession, you're going reverse. It's actually the country takes a pay cut. There's difference between contraction and slowing. So in the mid-1990s, what happens? Well, 1995, in the summer, Netscape goes public and then unleashes 5 years of uninterrupted wealth creation and productivity because of the onset and widespread distribution of the Internet. So I was always saying, and I'll say to the group, tell me, what is going to be the big positive external shock that's going to manage to overwhelm the lags from what the Fed and the Bank of Canada have already done just in the past 8 months? And I'm willing to keep an open mind. Tell me what it is. I don't see it. So I was saying back then, 80% chance of recession. We'll talk about how those odds have altered over the course of the past few months. The other thing we've got to keep in the back of our mind is that whether we've had a soft landing or not, Oh yeah, we had a soft landing in 1994-95, right? Was it a soft landing in Orange County? Don't think so. Was it a soft landing in Mexico? I don't think so. So it doesn't matter if soft landing, in terms of the portfolio, in terms of financial accidents, you see the thing is that everything in our business lives and breathes liquidity. These central banks have been draining liquidity out of the system. And there's never been a time historically where they've been doing this where at some point you did not have a financial accident, recession or no recession. And you're starting to see the cracks. Even before what happened in the UK gilt market back in September, we started to see it in the Chinese property market, which is ongoing. Look at where the price of the real estate debt, look at where that's being priced in China. And now it's spreading to Indonesia, to Vietnam, to Korea. You're seeing the spread throughout Asia right now, the property debt crisis. And we know, looking at Canada, it's become global. Is it the property market? Is it the equity market? What about crypto? Right? Crypto has just gone through its own little mini crash. There are so many bubbles created in the past 2 years where the Fed and the Bank of Canada went crazy, opening up its bathrobe to zombie companies. I mean, buying high-yield bonds or telling the public we're ready to buy high-yield bonds. Think about that. I was getting calls from clients who think they'd ever buy equities. And then they left rates, and even in the housing bubble, they're buying mortgages into the housing bubble last year, which is totally irresponsible. So, the central banks created this mess yet again, and that's the whole business cycle. It's all about central banks overdoing it on the easing side, overdoing it on the tightening side, and they did that big time these past 2 years. And look, my friends, we're going to pay a price for that. Now, look, I don't want to sound overly dire. They do call me the perma-bear. I started October 19th, 87. I struggle, actually. And I feel sorry for you folks, actually. I struggle because I don't know. When the organizers invite me here for lunch, I say, well, I don't know what to do. If you have me speak before, I'll ruin their appetite. I speak after, they'll get indigestion. So it's a no-win situation. I think the best economist of all time was a physicist, a Nobel laureate in physics, and we all know who he is, Albert Einstein, who famously said that compound interest is the eighth wonder of the world. Ain't that the truth? So interest rates, for anybody who has to do cash flow analysis, what matters more than interest rates? And we're going through, when you compare the timeline of other tightening cycles in the modern era, we have never seen this before. Almost 400 basis points in less than 8 months? We've already lumped in an entire tightening cycle into a couple of quarters. And this time last year, I'd be talking about that the market was pricing in 0%, and the Fed was telling us 0%. To perpetuity. I think that this time last year, when you look at the Fed's dot plots, they were talking about maybe 2 rate hikes for this year. That was it. Look how far we've come. So now they're talking about 5%, 0 to 5 in less than a year. And then we got to tack on quantitative tightening because they're also reducing the size of their balance sheet. And we're seeing what's happening in the housing market, right? The Fed hasn't even started selling mortgages yet. And the mortgage rate is already above 7%. They're just selling treasuries. Reduce the size of their balance sheet. You know that when you combine this with what they've done with the funds rate, it's as if they would have raised rates 600 basis points this year. Nobody has done that since Paul Volcker in the early 80s. Surely if you didn't hear of William McChesney Martin, you've heard of Paul Volcker. This is the tightest monetary stance that we've seen, and this is what matters most. I get asked the question, should I buy the stock market today? Look at the CPI. Are you kidding? That's a short covering rally. That's a trade. Here is the most tried and true relationship, is the S&P 500 with the Fed's balance sheet. Look at that. What else in your life has more than a 90% correlation? And they're tightening their balance sheet. And so the trend in the stock market is going to go down. You can't argue with a 91% correlation. So, it's like the story. People ask me, should I buy the market? Look at this chart. It's like the story of Marvin and Norman. Marvin comes home and catches his best friend Norman in bed with his wife Sylvia, his best friend for 45 years in bed with his wife Sylvia. He says, Norman, I have to, but you. So basically, what I'm saying, you don't have to be that person. I would say use these opportunities to cleanse your balance sheet, The stock market, this bear market, is not over, not by a long shot. Today's number didn't change that. So Powell's giving us a lot of information, right? Tells us in the summer, significant additional tightening, significant. And he's already been doing that. Then he comes after Jackson Hole and he says, I'm going to inflict pain. He's coming right out. I'm going to inflict pain on households and businesses. This guy's gone from, he was like the resident social worker during COVID. Okay? All-inclusive unemployment rates for every minority group. Now he's going to inflict pain. Okay? So basically, from Bambi to Godzilla in barely more than 12 months' time. And indeed, the pain, look at the pain. You know, the only reason why the stock market's only down 20%, okay, after today, only down 18% so far this year. It's because of healthcare and because of energy. But you're seeing wide swaths in the financials and the deep cyclicals are in painful bear markets. And it's not over. And he says, I'm going to deliver more pain. But I smelled a rat when he told us in March that he said, we're not going to be focused on the supply side of the economy. Can you imagine him coming out and saying, we're not assuming significant near-time supply side relief? I can't believe that. When I went to economics school, they taught us that if you're going to forecast the price, you need two curves. You need a supply curve and a demand curve. And he's saying we're going to operate policy with a blind eye towards what's happening on the supply side. And of course, because once burned, twice shy, you know, we had the Omicron, and then we had China. God forbid you get 5 COVID cases. They shut down a port city of 20 million people, and that screws up global supply chains. We're going to ignore the supply side. And I was saying at the time, boy, oh boy, we are bound to have the Fed dramatically over-tighten if all they're focused on is the demand side. And the demand side was always, yes, the reopening, rearview mirror for the most part at this stage, and fiscal stimulus, again, rearview mirror. Temporary stimulus checks. Most of that has been spent, gave us a great, great juicing up of the economy here and in the United States. It's over. But he's telling us we're going to ignore the supply side of the economy. Meanwhile, the supply bottlenecks globally are melting. You're seeing that in the freight rates. You've seen that in the commodity markets. You're seeing that in the poster child of supply chain pressures. The supply delivery indices have been plunging, and they're turning a blind eye. The New York Fed, the New York Fed has its own global supply chain pressure index. It's down to almost a 2-year low. We're almost back to where we were pre-COVID. But we're going to operate policy without looking at all that stuff. So we're going to go 75, 75, 75, and then today a pivot today means going 50. I remember a day when a pivot meant you went to the sidelines, central bank, or you cut rates. Today's pivot is going 50 basis points into an inverted yield curve. That's today's pivot. Ooh, pretty scary how we've defined that. Meanwhile, we know what the story in the commodity pits have been. He's ignoring that. He's ignoring the deflation we've seen broadly based from the peaks. I know levels are high, but inflation is a rate of change. It's not a level. And you're seeing the initial run-up in the inflation actually did not come in the labor market. It came in the commodity market. And now we're seeing the movie run the other way. And to quote Warren Buffett, and I think this is the best, what we learn from history is that people don't learn from history. Let's just call it for what it is. What was this? Inflation. You know that when you go back to pre-COVID, you go back to, say, January, February 2020, same unemployment rate, same employment to population ratio, same participation rate, same level of the industry operating rate. People talked about the great return of labor. Amazon and the unionization, which has stalled out. And at Starbucks. But actually, the capital to labor ratio today is the same as it was back in early 2020. And if you're taking a look at the 3-year rate of change in GDP is aggregate demand, okay? The 3-year annualized percent change going up to COVID was 1.7% at an annual rate. I say 3 years because here we are 3 years since the onset of the pandemic and through the whole roller coaster ride. Pandemic, the lockdowns, all the stimulus, and then what's happening today. Guess what real GDP growth has averaged the past 3 years since COVID? Anybody want to guess? 1.7%. So help me out with this because it's important. The level of demand growth since COVID started is the same as it was in the comparable period before COVID. And I'm supposed to buy into everybody's view, which I've had to do. I've had to actually get into yelling matches with my own clients. That the level, if this was actually some unrepentant, booming demand story, I'd buy into the big inflation.
If I bought into the 1970s when all the boomers were buying 3 refrigerators and 4 cars, we don't have that demographic demand. Come on! The inflation was all the supply side. It was all supply side. The demand growth, and the Fed's telling us, oh, we're just not going to focus on the supply side, but now the supply side is moving. We saw it today, very disinflationary. We have a sample size of 1. Let's go back a century. We had the Spanish War, and we had the Spanish flu, and we had World War I. We had the war. At this point, this cycle, we had the health crisis, then the war, first shooting war in 80 years in Europe. Back then, and that was inflationary. Wars are inflationary, but they don't last forever. And a century ago, we had a health crisis that followed a war. And you want to talk about big inflation? From 1960 to 1920, inflation averaged 15% per year. I call that like big inflation, okay? I don't call 18 months of like, oh my God, the guys on CNBC, 8% inflation. Yeah, and it's in the rearview mirror. This was 5 years. Exactly. Global healthcare crisis is inflationary. And wars are inflation, what they do to global supply chains, absolutely. And then once those pressures subsided in the 1920s, we had a decade of deflation and disinflation. The worst thing anybody could do is extrapolate all the distortions, disturbances from the COVID and everything that happened that associated with the COVID. I'm not saying that COVID is over. It clearly is not completely over. But the thing is that the supply pressures are subsiding. And the level of demand growth hasn't changed. So you tell me, if I'm teaching an Economics 101 course, what inflation view does that lead you to believe in? And then, of course, we're seeing the money supply numbers and all the inflationists. Look at the money supply, look at the money supply, look at the money supply. Yeah, last year the money supply growth led the inflation, and now we're seeing the money supply numbers. Now with the Fed raising rates, Bank of Canada, these charts look the same here, money supply numbers are slowing down dramatically. And real money supply is actually running at levels, growth levels we last saw in the 70s and 80s when we actually went into deep recessions. So I don't even buy into the mild recession story. People want to believe that. Then we have what the Fed's doing here, which is raising interest rates into an inverted yield curve. An inverted yield curve is, in the bond market, it's when long-term interest rates are below short-term interest rates. Normally, because of the time value of money, long-term interest rates are above short-term interest rates. But when the Fed is tightening, and we have this unusual situation where, say, 10-year bond yields are 50 basis points below 2-year bond yields, it's the bond market's way of saying to the Fed and the Bank of Canada, Uncle, you've gone too much. That's what the bond market's been saying. And this is that spread between 10-year yields and 2-year yields. It's negative. Only one other time historically have we had a head fake, and it was the 1998 Asian crisis when bond yields actually rallied into that inversion, and then Greenspan cut interest rates. But you tell me, every time you look at this chart, and the bond market gets it right all the time. Just so happens the stock market's getting it right too. Somebody sneezed. I know this is I'm allergic to this chart too, but that's why I'm staying away from it. The yield curve is a phenomenal leading indicator. And people say, but the Fed's got to know this. The Fed's got to know this. Well, the Fed's following something else, right? I mean, he's talking the unemployment rate, meaningless. It's a lagging indicator. Inflation rate. Headline inflation, please. This is what I'm talking about. He's following lagging indicators, or that's what he's telling us. The chart on the left is the Conference Board's index of lagging indicators. And you know what goes into that? Service sector inflation. Everybody says to me, oh, look at the rents. Look at service sector. Service sector inflation is so sticky. To which I say, that's a lagging indicator. I don't care about lagging indicators. I don't live my professional life that way. They say, well, the unemployment rate. The unemployment rate's a lagging indicator. They say, well, what about wages? Unit labor costs are in that index of lagging indicators. Does that interest anybody in the room? We see that's what the Fed would show you. Look at the lagging indicators. It's actually hitting new highs. Coincident indicators is also hitting new highs, but at a slower rate, and that's non-farm payrolls. But that's a coincident indicator. What do you want when somebody like myself comes into the room? Do you want us to talk to you about 2022, or do you want to talk about the outlook for 2023? Well, I think we want a plan. The leading indicator. The leading indicator, by the way, the yield curve is part of that, is gone down 7 months in a row. The leading indicator. And it's down at over a 5% annual rate. And you can see for yourself when you have this condition, you actually are in a recession, not 80% of the time, not 90% of the time. I'm going to take back what I said before. Actually, I think this is telling you there's a 100% chance we're going into recession in the next 12 months. Now, I asked about McChesney Martin. Now, by the way, is it a bear? It's just a realistic call. The business cycle is the business cycle. And what these central banks have done, and they did us no favors, that they created a boom bust. And that's what we have. We had a boom, and now we're going to have a bust. Look at this guy. Remember him? Paul Volcker with the stogie? Now, Jay Powell, he should compare himself more to McChesney Martin because he has taken the punch bowl away. But he calls, from a macro standpoint, he calls Volcker not once but twice the greatest economic public servant of the era. People don't know they were like burning effigies of him outside of the Fed back in the early 1980s. And not just that, but look what he says. He says, this is back in September, that they're strongly committed to their project of raising rates and tightening policy and tightening up liquidity, and we'll keep at it. We're going to keep at it. Look at Volcker's book that he wrote a year before he died, Keeping at It. And the sad thing here is that Volcker's not even alive to collect the royalty on the fact that Paul's using his line. But we got a guy who actually is the modern day Paul Volcker. Now, I'm looking around the room. Most people don't know what it was like in the early 80s. It was rough. Now, he killed inflation by killing the economy. And I'm trying to tell you, that's what Powell is doing. He is over-tightening. He's done it already. Don't talk to me about today's CPI number. They've already locked themselves in to another rate hike in December. Maybe it'll be 25 basis points. I still think that's crazy, to tell you the truth. But this is how Volcker did it to inflation. He killed the economy. Unemployment rate doubled. This is it. 3-year bear market in equities. And people revere Paul Volcker. They don't have no idea that Donald Reagan, former CEO of Merrill Lynch, long before I was there, he was Ronald Reagan's Treasury Secretary, tried to get Volcker fired unsuccessfully. Killed demand. I'm not going to focus on supply. This is Volcker. I'm going to focus on demand. He killed the economy. You think central bankers aren't equipped to kill inflation? You think inflation is here to stay? You think we have some secular new inflation because of COVID? Because you can't forecast inflation with one curve. And by the way, both curves right now are moving towards deflation. I hope I'm invited back next year, because that is I'm not going to say it's 100% clad. It's my base case scenario. And look what happened to the bond market. Bond yields went down. Now, it's very interesting that bond yields are still going up because the Fed is still tightening, just like into the recession, Volcker's still tightening. Bond yields won't come down for good until the Fed is done. But when they come down, they're going to come down hard. So the one thing I want to say here is, once again, who is the real Jay Powell? And this is the real Jay Powell when he was governor. And the things that he was saying back then at the FOMC meetings and speeches. He was dead set against QE. He argued and debated with Bernanke about it. Talked about how it undermined financial stability. Over time, look at the last sentence, it leads to unsustainably high asset prices and credit growth. And he's unwinding all that. You see what I'm saying? Capiche paysan? He is basically unwinding all that. Here's what he's doing. And of course, that has an influence on everybody in the room because it has an influence on the economy. I say taken the punch bowl away. He is single-handedly, and he's got the whole committee behind him. And he's got Biden behind him too, amazingly enough. That he is basically repudiating the Greenspan-Bernanke-Yellen doctrine of creating wealth effects on spending by artificially stimulating asset prices. See, the future is not inflation. The future is taking the punch bowl away and creating some separation between the financial economy and the real economy. That's what's changing. Does this chart make anybody feel comfortable in the room? This chart, this is what I'm talking about. This is what he's trying to break. This is household net worth, my house, my God-given right to have my house go up 25% a year, and my equities. Oh, and then my crypto. Oh, Kathy Wood. I'm rich, I'm poor, I'm rich, I'm poor. Look at this. Look at this chart. Look how insane it got going into this year. Now it's correcting. 800% ratio of net worth to disposable income. Do you see how insane this chart is? Has anybody ever seen this chart before? Okay? You know, if we mean revert to 610%, if you actually did the negative wealth effect on spending, that would lead to an 8% GDP recession. That would be twice as bad as what we had in 08 and 09. That chart mean reverts. Don't take it from me. The San Fran Fed did a report in 2018 where it said this ratio tends to revert towards its historical average and does not remain at extreme levels, either high or low, for prolonged periods. Does not stay at high or low levels for look where we're coming out of.
and people think this is going to be a mild recession, I think that's a hope and a prayer. It's funny, the people that were saying no recession are now saying, yeah, it's a mild recession. I'm not so sure. I'm not so sure. I'm very worried about the fact that the Fed, remember what happened 2000, 2001, coming off the March lows. Look what the Fed did, the Bank of Canada. Remember, who knows FOMO? Who heard of FOMO? Fear of missing out. Or TINA, there is an alternative, right? Well, now, 4.5% T-bill yields, you have an alternative. I guess now we're going to call it TIA and not TINA. Oh, don't fight the Fed. Don't fight the Fed. The Fed has your back. Yeah, and guess what? The Fed still has your back, but it has a knife in it, and it's twisting it. And so that's what I'm talking about is these charts. So what they did, they lured, I'm not talking about anybody in this room, but you've got to think of all the low-income, middle-income people that thought, all these people, like with Robinhood, Reddit accounts, I mean, come on, these are young people. They don't have a lot of money. The Fed made it into a get-rich scheme. It was like they were running a casino for 2 years. We're paying a price for this right now. Historians will be writing about this period of time. I'm not concerned about the rich people. They'll be fine. But all those people they sucked in, the middle and low-income people who used their stimulus checks, you see what I'm saying, to buy the stock market. Look what's happening now. So we went into this year with $45 trillion of naked long-only equity exposure on household balance sheets. At the height of the dot-com insanity, it was basically what? 10 trillion. During the credit bubble in the last cycle, 45 trillion. And look at that. And look at the ratio on household balance sheets going down. This is just starting. This mean reversion is just starting. What about residential real estate? Residential real estate and equities are tied at the hip. They are both the longest duration assets in the economy. They are ultra sensitive to interest rates. Back in the last cycle, it was the housing market that led the equity market down, and this time around, it's the equity market leading the housing market down, but it doesn't matter. They're both responding to the same thing, which is a lagged impact of this gargantuan increase in interest rates. Charts look the same in Canada, by the way. In fact, they're worse. The bubble is worse in Canada. The credit bubble and housing bubble in Canada is worse than it was at the peak of 2006, 2007 in the United States. These are U.S. charts because the U.S. is richer in data in this regard. And you can see we went into this year, I mean, seriously, the home prices were going up faster than they were during the bubble in 06 and 07. And we know it was a bubble, right? We know it was a bubble back then. Housing is in a bigger bubble. We can call it a bubble. It's a very big deal to call it a bubble. I'm going to tell you why. Back in 2006, I'm chief economist at Merrill Lynch, and my boss, Candace Browning, who's head of global research, calls me and says, I can't protect you any longer. The wolves are at the doors. You are no longer allowed to use the words housing bubble in your reports because it's too emotional. I said, wait, I can't use the word housing bubble anymore in my reports? She says, no. You find another word. I said, how about mania? How about housing mania? She says, that's fine. I said, okay, that's good. I'll speak to you later. I mean, we went into this year. Canada takes 12 years of income. That's coming down. 12 years of income to buy a home. Insane. Double the historical norm. And you could say, well, back when rates were at zero, yeah, if you interest rate adjust it, but rates aren't at zero anymore. In the U.S., it's 8 years of income. It's actually, in that regard, as big a bubble as it was back in the mid-2000s. How is this going to end? Let's look at 2023. How do you think this is going to end? This is all the stuff I was talking about in 06 and in 07. And then we know what happened in 07 and 08. But because everybody just lives in the moment, right? Can't see past the tip of your nose. I'm giving you a forecast for the next year. And I know it's not a pretty picture. But it's a realistic one, and that's all I really care about. So in the stock market, in a recession, you go down 9%. In the lead up to the recession, then down 22. You're down about 30. That's just an average. The median's about the same. And you can see here that the stock market peaks before the recession, bottoms before the recession ends, bond yields go down, and then they stay down even after the recession is over. This is very important. And bond yields, by the way, I'm very bullish on the fixed income market. Bond yields go down 150 basis points. I think that if you buy the zero coupon treasury bond, the strip, in my forecast, you'll make more than 30% in the coming year. I don't think the stock market's going to do that for you. And this is what things look like in a recession, looking at them all. This is what life looks like. Okay, so basically you're taking a look at the stuff on the left. The stuff on the left, my friends, that is forbidden to you. Okay, people say, oh, emerging markets. Yes, emerging markets. Look at worst performing asset class. Emerging markets, as Don Cox famously said, are markets you can't emerge from in an emergency. And then you can see gold, though. Gold hangs in. The dollar hangs in. Cash, you get paid to be in cash, bonds, and blue chip dividend stocks get rewarded. The Wall Street Journal said you can't predict when bear markets end, so don't try. Well, I tried. I'll tell you this much. Neil Kashkari, who used to be the biggest dove, is now the biggest hawk. And he's telling you right here, after Jackson Hole, they want the stock market to go down. They want the stock market to go down. It's funny because no one ever says to me, don't fight the Fed anymore. Oh, back in 2020, 2021, don't fight the Fed. But you don't fight the Fed in both directions. The thing is, the alarm bell. When does the alarm bell go off? That basically we're into a whole new bull market in equities. I reintroduced the chart on the right. It's when you're 70% of the way into the recession. It's just getting started. And you're 70% of the way into the Fed easing cycle. They haven't even paused yet. So what are we talking about? There's never been a bottom in the stock market with the Fed still raising rates into an inverted yield curve. No. You could see that at every bottom in the stock market back to 1980, the Fed has cut rates radically, and it's usually late in the game of the easing cycle. This might be the story for late next year. I'll come back with the story late next year. But this is really what we're talking about here, because people are going to start to talk about the pause. I think they're going to pause too. They might have one more rate hike for show in December, then they're going to pause. And yeah, the market's going to rip temporarily. It's not the real thing. Take a look at that table. That's all you need to know. The start of the recession. Look, let's go to the Fed pause. Let's go to the Fed pause. They paused in July of 06. Hallelujah, they're not raising rates. Oh, what do you know? A recession starts in December 07. They paused July of 06. When does the stock market bottom? March of 09. Oh, they paused in May of 2000 because of the tech wreck. When did the stock market bottom? October of 02. We're in this for the long run, my friends, okay? So you can see that what happens is that the S&P bottoms 70% of the way into the easing cycle. And historically, that means that after they pause, and let's say they pause in December, it's 16 months from the pause to the low. So please, you want to trade the market? You think you're Paul Tudor Jones? Trade the market. This will not be an investable market from the long side for the next 12 months. Last slide, and I could just hear this palpable sigh of relief. But this is actually just the guide. What has to happen, the reason why bond yields have to go down. Bond yields, if you're going to be bullish on equities, bond yields have to go down. You have to be bullish on bonds before you're bullish on stocks. The chicken's got to come before the egg, and this always happens. Bond yields have to come down to give the relative valuation support to the stock market at the fundamental lows. Not these little whippy bear market lows. The market's going to whip around. It's whipped around all year long. It's still down almost 20%. There's going to be buying opportunities. If you want to trade the market, go trade the market. But the equity risk premium has to widen 450 basis points. We've only done a fraction of that. That's why bond yields going down is so important. Bond yields go down to enough of a level, usually down 150 basis points. So you know what? Call me up when the 10-year note is 2.5%. I might start turning more bullish on stocks, but for now, my first asset mix shift is going to be into the bond market. Number 4 is the most important. Number 4 is basically you want to wait for the yield curve to steepen. The yield curve. You know, people say to me, if you lived in a desert island, a lot of people wish I did, by the way. If I lived in a desert island, what would be the one tool? It'd be the yield curve once again. When the Fed has cut rates sufficiently, I said normally the bottom in the stock market is 70% of the way into the easing cycle, which will be story for late next year. That 2-10s curve, which is now negative 50 basis points, at the lows it's plus 140. So, you know, feel free to take pictures of that, because that is your guide for when it's going to be safe to dip all 10 toes back into the risk pool and not before.